A hush fell across Wall Street and Main Street alike as the Federal Reserve held its benchmark interest rate steady at 4.25% to 4.50% on July 30th, 2025, the fifth consecutive decision without change. The stakes are high, the tension palpable. Markets had priced in a near certainty of stability, with the FedWatch tool assigning a 97.4% probability to a hold, reinforcing the sense that something critical is looming. This episode asks, how will the Fed's imminent choice reshape your mortgage, savings, and job prospects in the final stretch of 2025? Echoes of past inflation wars resound. What once required dramatic tightening in the early 1980s now unfolds with razor-thin deliberation. The Fed's decision to pause enters a landscape haunted by history, yet cautious about repeating it. The Fed funds rate remains anchored at 4.25% to 4.50%, unchanged since December 2024. However, expectations are shifting. Markets now anticipate multiple rate cuts. Some foresee 2 cuts by year-end, others even 4, starting potentially in September. Headline inflation sits at 2.7% year-on-year in July, steady and still above the Fed's 2% target. Core inflation, excluding food and energy, is even higher at 3.1%. July brought a sobering surprise. Only 73,000 jobs added, far below expectations, alongside downward revisions of 258,000 jobs for May and June. Unemployment is creeping upward toward 4.2 to 4.4%, signaling growing fragility. President Trump's mounting pressure, accusing Fed Chair Powell of mismanagement and even threatening lawsuits, adds a political edge to this high-stakes economic drama. Meanwhile, Fed officials such as Mary Daly are trending dovish, signaling openness to cuts amid the murky economic outlook. The average 30-year fixed mortgage rate hovers between 6.7% and 6.8%, slightly down from early-year highs near 7%, but still daunting. For 15-year loans, rates range from 6.0% to 6.3%. At the start of 2025, the U.S. homeownership rate stood at 65.2%, with the average homeowner holding about $311,000 in equity. But with high mortgage rates clouding affordability, many feel tethered to their homes, locked in by golden handcuffs. Sluggish job growth and inflation above target sets the Fed at a crossroads. Balance price stability or risk layoffs. President Trump's ongoing tariffs raise costs and uncertainty, complicating the inflation picture. Attacks on the Fed's independence and threats against Powell intensify the stakes behind every data point. A critical inflection awaits at the September 16th to 17th Fed meeting. Will the numbers justify a cut, or will caution win the day? Analysts like Jerome suggest a 50 basis point cut could be entirely plausible, with markets pricing in shifts already. JP Morgan's updated forecast even sees 4 cuts on the horizon. So, the policy and strategic implications are that homebuyers and refinancers may see relief if rates begin to slide. Yet many remain hemmed in by existing high-rate lock-ins. With federal rates near 4.5%, returns on safe assets remain modest. Any cut will pressure yields, flattening returns further. A rate cut could cushion job growth, but if inflation resurges, the Fed risks undercutting its own credibility. In mid-2025, the Fed stands at a tension-filled crossroads. Inflation steady yet above target, labor market softening, political heat intensifying. The September meeting promises to be pivotal. Will the Fed act to protect jobs or hold tight to contain prices? The answer may quietly arrive, but its echoes will be felt across every wallet, every mortgage bill, and every paycheck.